Good afternoon. It's May the 14th. I'd like to talk to you about the auction process and where it went today and how auctions are actually done. Every other week or 6 days a month we have to deal with an auction market, and we have to understand auction dynamics to prosper under these conditions, because it's a manipulated market and the dealers understand how to manipulate prices and how to push the market around. And the most likely occurrence is the first auction is usually up, that's the 3 or the 2 year paper. The second auction is usually down, that's the 5 or 10 year paper. And then the third auction is usually sideways to higher, that's 7 or 30 year paper. And today we had to move 30 year paper. When you understand the government auction process, the government issues securities, notes and bonds, and they would like to pay 0% interest. They'd like to get your money and pay you as little as possible. Primary dealers are the wholesalers for the government. They buy direct from the government. They mark up and sell to their clients. The client would like to get as high an interest rate as they can. So the government wants to pay low, the client wants to get an interest rate on it, and the dealer is in the middle, the primary dealer facilitating it, and he gets paid commissions or the spread between the bid and the offer. 1 week before the auction, you have the announcement by the government about the amount of the auction. And the when issued market starts trading, and it will trade about a week before the actual auction, and at the auction there is no more when issued market. So in this week, this period like this, a large institution that wants to buy, in the case of today, 30 year paper, will be trying to buy when the market corrects or sells. The broker will be trying to get as much as he can, work the spread between the bid and the offer to make trading profits for his firm. So over the course of the week, the broker, the trader, the primary dealer will know exactly where the bid is, and this is what they're going to work. They're going to work the bid from their institutional clients. And the way they work that bid is they'll take the market down just about to where that bid is. The broker will call up the client and say, hey, you wanted to buy the 30 year at such and such a price, buy it now. And the client will come back and say, well, that's 2/32 seconds higher than where I wanted to buy it. I'm not going to pay that for it, and I'm going to keep my bid right here. If you'll give it to me at this price, I'll buy them. And the broker says, I'll talk to my trader. The market moves up and away. Market comes back down, and now the offer is going to be even higher than it was before to try to get the client to move his bid up. And the guy knows he could buy it here at that price on the last one, so usually the bid will come up. And the broker will talk to the client and say, well, you just missed a heck of a trade that would have put you in the profit already. Are you going to buy him here? And he says, yeah, I'll buy him at this price. He says, well, it's offered 2/30 seconds above that. Pay up, get in the market. And the guy says, no, I'm going to take it this price, and the primary dealer takes it away from him. And back when I had a cash business and I was a broker and I did participate in these markets, I can't tell you how many phone calls we made over the course of the week trying to jockey and get the new issue at the price we wanted. And we understood how the market worked and how the primary dealers worked it, but we were hoping for a news announcement or something that would enable us to get in better. So today we came in and we had news that was on balance negative, and the market sold. We were buyers. We like the buy side of the market, and we're trying to buy. So what you can see right here is that the bid for 30 year paper is down in the 152.08 area. The day session opens and this market actually comes in at 910. It's a couple of ticks higher than where it was right there. And the market has sold down to this, was selling down to this point, and on this bar down here you can see the primary dealer starts to support the market. And we're a couple of ticks higher than where it was. So the broker talks to his client, do you want to buy him here? And he says no. And the primary dealer takes the offer away, and the market moves up. And the mechanism for doing that is they buy futures. And you can see this in pane 3. The market comes up here, it kind of stalls, it comes back down. We know where the client wants to buy it. We pick up the phone and said, hey, I can sell you those 30 years now at 152.12. And he says, no, I'm not going to pay that for you. I'll pay you what they were the last time you called up. I'll pay you 910. And the broker says, I'll talk to my trader, and the trader takes the market away from him. And this is how the bid gets ratcheted up into it. Now the market cannot go straight up, so right here we get some quick selling. The market comes back down, but what you'll notice right here is that that price is much higher than it was before. The broker calls up his client and asks him if he wants to buy him here, and he says, no, I didn't buy him at the other price right there. I'm going to hang around and see if I can get him. And I'm going to erase this now so we don't get confused. And you can see where the dealer takes the price away from him one more time. And we get a higher offer right here. And then here comes the auction. Now, we have all this buying interest back down in this area from when the market opened. And it's a bad auction. It does not work. And look what happens. The market comes right back down to this point. That price point holds. It's a couple of ticks higher than that, and the market rallies back. So the client, the person that wanted to buy the 30-year never was able. He had two opportunities to buy in this area, and he never did get a chance to buy it again. And you can see how the market rallied up in the post-market too. So this is how auctions work. You have to be very cognizant of this interplay between the Treasury and the client and the primary dealer in the middle. You can see how the market is manipulated. They cover shorts or they buy futures to push the market up. They don't really abandon the long side right here. They stay long. They take it back up in here. Even in the auction, when the market sells right here, you can see the primary dealers are supporting the market. They're buyers into this break off the auction, and then they hold it steady during the day. So understanding where the primary dealer is, what his role and function is, knowing where to go look and find out what they're doing, which is right down here in pane 3, can really make it much easier for you to trade the Treasury auctions, which you face 6 days a month. If you'd like to know more about government auctions, how they work, how to trade these, come visit us on auction day. Come into our main trading room and we'll talk you through it and we'll show you how it's done. Please come to our website at www.cnfuturestrading.com. At our website you'll get information on auctions, how to trade them. We offer you 5 free days in the main trading room. Check us out during an auction, a government auction, see how we do. Please contact us via email at info@cnfuturestrading.com or call us directly at 312-361-3895. I'm looking forward to seeing you in the main room for your 5-day free trial offer. Come join us during the auctions.